All right, let's get right into it. If you take a quick glance at the latest financial results for the luxury hotel group Shangri-La, you might scratch your head a little. You see, the big headline number seems to tell a story of decline. But when you start to peel back the layers, a completely different and, frankly, a much more interesting picture starts to emerge. So let's unpack that story together. So let's kick things off with the central puzzle here. On one hand, you have Shangri-La's core business, which is actually getting healthier. But then on the other hand, that final profit number, the one that grabs all the headlines, it took a pretty significant hit. How in the world is that even possible? So yeah, how can it happen? How can your total profit tank by a whopping 30% while your day-to-day operations are actually getting stronger? Well, the answer really comes down to understanding what actually goes into that final profit number. And this slide just lays out the paradox perfectly, doesn't it? I mean, look on the left, you've got operating profit. That's the number that tells you how the actual hotel and property business is doing, and it's up a really solid 6%. But then, the number everyone sees, total profit, is down over 30%. So what's happening in between? The culprit, it turns out, is something called non-operating items. The easiest way to think about these is as one-off financial events that aren't really part of the regular business of renting out rooms and office space. In this specific case, the big swing happened because Shangri-La's investment properties gained less value this year than they did last year. Now, it's not a loss, just a smaller gain. But because of accounting rules, it has this huge effect of dragging down that final profit number. All right, so with that little accounting mystery out of the way, let's look at the real engine room of the company. Where is the actual business performance, the real growth, actually coming from? It's probably no surprise to anyone that hotels are the absolute heart of the business, right? I mean, they make up nearly 90% of all the revenue. But the growth story is actually hidden in those smaller slices of the pie. And wow, this number just says it all. The revenue they get from developing and selling properties, even though it's a tiny part of the overall business, it just exploded. It grew by over 300%. And that's all thanks to some really successful sales in places like Sri Lanka and Dalian, China. And their other properties, the offices and commercial spaces they rent out, they also gave them a really healthy and reliable boost, growing by almost 11%. This is just that steady, solid part of their income that keeps on delivering. Okay, let's get to the main event, the hotels. When we dig into this part of the business, it's not really one single story. It's more like a tale of two very different markets. It turns out, location is everything. This slide tells such a crucial story. Just look at Hong Kong. It's bouncing back, and it's bouncing back strong. Revenue's up, occupancy is at a super healthy 82%, and RevPAR, which, by the way, stands for Revenue Per Available Room, is up 8%. But then you look over at mainland China, and the market is just softer. Revenue and RevPAR are down, and that occupancy rate is lagging way behind Hong Kong. And the good news isn't just limited to Hong Kong. When you look at their other big international spots, you see a really positive trend. We're talking Japan, France, Australia, Malaysia. They all posted fantastic revenue growth. It just goes to show that global travel demand is really robust, even with the challenges they're seeing in mainland China. Okay, now this next part, this is arguably the single most important takeaway for anyone looking at this company from an investor's point of view. It's kind of a secret about the company's hidden value, and it's all locked away right there on the balance sheet. So here's the key thing you have to understand. Because of some standard accounting rules, Shangri-La's huge portfolio of luxury hotels, which are often sitting on prime real estate, they're valued on the books at what it costs to build them, which in some cases was decades ago. That number doesn't even come close to reflecting what they're actually worth on the market today. So, if you just look at the official report, the company's net asset value, or NAV as it's called, is about $1.50 per share. That's the official by-the-book number. But here is the aha moment. If you actually go and adjust the value of those hotels to what they'd be worth at today's market price, the NAV per share more than doubles to over $3. That suggests there is a massive amount of potential value here that just isn't being reflected in any of the headline numbers. So now that we know the business is fundamentally pretty sound and that there's all this hidden asset value, what's the plan for the future? Let's take a look at their forward-looking strategy. The company's laid out a really clear three-part strategy. They're going to focus on innovating their brands, growing in what they call an asset-light way, and, of course, maintaining strict financial discipline. Let's break each of those down real quick. First up, brand innovation. And they aren't just talking about it, they're actually doing it. They've already launched a brand new ultra-luxury brand called Shangri-La Signatures. They're pushing into an even more exclusive part of the market, which shows they're really evolving and trying to meet new traveler demands. Second is this asset-light growth. Now, this is a really clever strategy. Instead of spending billions and billions of dollars to build new hotels from the ground up, they're focusing on signing contracts to manage hotels that are owned by other developers. This lets them expand their brand footprint all over the world and earn management fees without having to put up huge amounts of capital. It's smart. And finally, financial discipline. You can see right here they've successfully lowered their average borrowing cost. So how'd they do it? Well, that third bar gives us the clue. They strategically shifted more of their debt over to the Chinese renminbi, which has lower interest rates. That's a very savvy move to make, especially in a high interest rate world. So we kind of end up right back where we started, but now with a much clearer picture. We know the day-to-day business is performing well, especially outside of China. We know there's a huge amount of potential value locked up in their property portfolio. And we know they have a smart strategy for the future. The big question that's left really is this. Can they successfully communicate this complex but really positive story and convince the market of what they're truly worth? This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.